Welcome to the deep dive. Today, we're jumping into the really quite fascinating world of home appraisals.
Yeah, and some pretty surprising things happening right now in the mortgage industry.
Absolutely. Our main source for this is a great Bloomberg piece by Emily Flitter. It's called Lenders Defy Trump's Appraisal Rollback from August 3rd, 2025.
A really insightful article.
It is. So our aim today is to unpack why these big mortgage lenders seem to be ignoring a recent presidential rollback on appraisal reviews.
Right. What does that defiance actually mean?
Exactly. For you as a homeowner, maybe someone trying to buy, or just, for the wider market.
The big question.
It really is. I mean, why would these powerful banks essentially defy a directive like that? What's that tell us about maybe the hidden side of wealth creation and fairness?
Yeah, the mechanics behind it all.
Okay, so let's start at the beginning. What's the actual big deal with home appraisals? Why should we really care?
Well, the thing is, appraisals can often be, frankly, unreliable. And that matters because, look, homeownership is the #1 way most Americans build wealth. Full stop.
Right. The biggest asset for many families.
Exactly. And the appraisal. That number determines how much you can borrow against that asset.
Huh.
So if the appraisal is off, well, it hits your financial future hard.
And it gets more complex, right? This isn't just about a few bad numbers. There's a history here.
Oh, absolutely.
Yeah.
It's a persistent problem across the industry, and historically, it's disproportionately affected minority groups.
How so? What's the evidence for that?
Well, there's quite a bit. For years, Black homeowners have shared stories, anecdotes, yes, but consistent ones, about their homes suddenly appraising higher after they removed, family photos, art, anything indicating their race.
So-called whitewashing the appraisal.
Precisely. And then there's harder data. Brookings Institution research, for example. It shows homes in majority Black neighborhoods are valued, get this, 21% to 23% lower than similar homes in white neighborhoods.
23% lower. Wow.
Yeah. And appraisal bias is specifically named as a factor contributing to that gap. Freddie Mac also did a big report in 2021.
What did that find?
It highlighted what they called a valuation gap in majority Black and Latino areas compared to white areas. Same pattern.
Okay, so it's clearly a problem for homeowners, particularly minority homeowners, but you mentioned it affects lenders too. How?
Right, this is key. It's actually a problem for the banks as well. Think about it. If an appraisal comes in too low, that homeowner might not qualify for a refinance or maybe even a purchase loan they should get.
So the lender loses that business.
Exactly. Lost business. But flip it around if the appraisal's too high, way above market value. Now the bank is holding collateral that isn't worth what they think. That's a huge risk for them if the borrower defaults.
So unreliable appraisals are just bad business all around. Risk and lost opportunity.
That's the bottom line. It creates problems for everyone involved.
Okay, so the problem's clear. What steps were actually taken to try and fix this?
Well, the Biden administration took a significant step. They formed the PAVE task force back in 2021.
PAVE. What's that stand for?
Property Appraisal and Valuation Equity. And it wasn't just, some small committee. It involved officials from 13 different federal agencies: HUD, Treasury, CFPB, VA.
13 agencies, so a major cross-government effort.
Absolutely. It signaled they were serious. And PAVE came up with Q recommendations. Some focused on the appraisers themselves, more training, higher licensing standards.
Okay.
The Appraisal Foundation handled implementing those, and those new standards from last year are actually still in place.
And what else came out of PAV?
A really big one was the push for something called a reconsideration of value, or ROV.
RV, what does that do?
It basically required lenders, industry-wide, to set up a process allowing borrowers to formally challenge an appraisal if they thought it was wrong.
So an appeals process.
Exactly. A standardized way to say, hey, wait a minute, I think you missed something here, and get it reviewed. Regulators started requiring lenders to standardize those procedures last year.
And how did the industry react? Lenders aren't always keen on new regulations.
Well, this is interesting. The ROV policy actually got support from the Mortgage Bankers Association.
Really? The MBA supported it. Why?
I think they saw the downside of bad appraisals, too, like we discussed. It wasn't just about fairness. It was about good business practice, reducing risk, and maybe avoiding those lost loan opportunities.
Makes sense. Do we have examples of how this RV process is working?
Yeah, the Bloomberg article quotes Michelle Rogers. She's the chief valuation officer at New American Funding.
Okay.
And she said, quote, "The changes have made it much easier for the borrower. It's more transparent, and the borrower knows they can initiate it. Transparency seems key.
And transparency helps build trust, presumably.
Right. And New American Funding shared some numbers too.
Oh, what did they show?
They said about 2.5% of their customers request a new valuation in ROV each month.
Okay, 2.5%. Doesn't sound huge, but maybe it adds up.
Well, here's the really interesting part. Of those 2.5% who contest their appraisal, roughly 22% are actually found to need an adjustment.
Wait, 22%. So more than 1 in 5 challenges leads to a changed value.
Exactly. Think about the scale. If a lender does, say, 10,000 loans a month, that's 250 challenges, and maybe 55 of those appraisals get changed. 55 times where the initial value is potentially wrong, impacting someone's equity or loan amount significantly.
It's actually a pretty substantial impact when you put it like that. The system seems to be catching real errors.
It does suggest the ROV process is fulfilling a real need.
Okay, so reforms in place, industry seeing benefits, data showing it works. Seems like progress. But then politics enters the picture again.
Right. Then came a shift with the Trump administration. They moved to scrap some of these guidelines.
Why? What was the reasoning?
Well, it was framed as part of a broader effort to eliminate initiatives the administration views as supporting diversity, equity, and inclusion, DEI. Yeah. The article quotes Housing and Urban Development Secretary Scott Turner, saying the rollback was about ending the, quote, obsession with DEI.
And this fit into a wider pattern.
It seems so. The article notes the administration has also signaled plans for pretty deep cuts to federal fair housing and fair lending enforcement. Things like reducing staff at the Consumer Financial Protection Bureau, the CFPB, and potentially changes at the Justice Department's Civil Rights Division.
Okay, so they rolled back the appraisal guidelines. Which specific ones? And did it apply to all mortgages?
Good question. It's important to be clear here. The rollback only applied to mortgages insured by the Federal Housing Administration, the FHA.
FHA loans. Those are often for first-time buyers or lower to moderate income families, right?
Exactly. They often allow for lower down payments. So this rollback directly impacted policies affecting that specific segment of the market.
Did it completely ban borrowers from disputing appraisals on FHA loans?
No. A HUD official confirmed lenders are not barred from allowing disputes. The requirement was just removed at the federal level for FHA loans.
Okay, so the FHA requirement was removed. Now, here comes the twist you mentioned earlier.
This is where it gets really interesting, yes. Despite this rollback, many of the biggest lenders in the country, well, they're making a different choice.
What are they doing?
Major players. The article names JPMorgan Chase, Bank of America, U.S. Bancorp, and also New American Funding. Again, they've all publicly stated they're making no changes to their policies because of this rollback.
So wait, the administration rolls back a guideline specifically targeting DEI, saying it's an obsession.
Right.
And these huge banks, Chase, BofA, U.S. Bank, they're essentially saying, nope, we're keeping the process even for FHA loans.
That's what they've stated, yes.
Yeah.
They're sticking with the ROB procedures.
Why would they do that? Isn't it easier just to follow the new, less restrictive federal guidance?
Well, this really speaks to the point we made earlier about business sense.
Yeah.
The industry seems to have found that the Biden-era changes, the ROV process, actually work for them.
How so?
Because fairer, more accurate appraisals are simply better for business. They ensure the collateral, the house is valued correctly. That reduces their risk.
Okay, less risk.
And it also means they don't accidentally turn away creditworthy borrowers because of a flawed low appraisal. Remember the lost business.
Right, right. So keeping the ROV process helps them make more sound loans and potentially more loans overall.
Exactly. It seems like the market efficiency argument, the pure business case for accurate appraisals, is winning out over the political signal to roll back DEI-related policies.
So the market itself is kind of self-regulating here, choosing accuracy and fairness because it aligns with their own financial interests.
It certainly looks that way. It's a fascinating dynamic where market forces seem to be upholding these standards, independent of the specific federal directive for FHA loans.
That's quite a statement about where value lies in the real estate process. So where does this leave things now? What's next?
Well, there's potential legislative action brewing. Senator Raphael Warnock, Democrat from Georgia, introduced a bill just last month, July 17th.
Okay, a new bill. What would it do?
Two main things based on the article. First, it would take those ROV policies we've been talking about and make them required by law for all mortgage lenders, not just a regulatory guideline or something lenders choose to do.
Codify it into law. Got it. And the second thing?
It aims to increase transparency by expanding public access to data on mortgage appraisals. It would push a federal housing regulator to share more details more regularly.
More data, more transparency. Who's backing this bill? Just fair housing groups?
Well, they're certainly involved, but here's another interesting point. The bill also has support from the National Association of Mortgage Brokers.
The mortgage brokers, that seems maybe unexpected. Why are they on board?
The article quotes their president, Jim Nabors. He called the bill critical for ensuring fairness for home buyers. He stressed their full board supports it.
So the brokers who work directly with borrowers and lenders see this as essential too.
It seems that way. It suggests a broadening consensus from advocates to industry insiders that standardized ROV and more transparency are needed.
Okay, let's bring this all together then. What does this actually mean for you, the listener? Whether you're thinking about buying or refinancing or just trying to understand the economy, what's the real takeaway here?
I think the central point is that this push for appraisal accuracy, even with the political back and forth, is really vital. It's vital for individual wealth building, especially for minority communities historically disadvantaged by bias.
Right.
Having a reliable valuation is fundamental, and having a process, the ROV, to challenge potential errors gives homeowners more agency, more control over their biggest financial asset. The data shows it's making a difference.
And for the broader market.
It points towards a more stable, reliable market overall, better risk management for lenders, fairer access for borrowers. It benefits the whole system when appraisals are accurate.
So it seems like even with these political shifts, there's this powerful current market forces, industry support, potential new laws, all pushing towards more transparency and fairness in this really fundamental part of our financial lives.
That's a good way to put it.
Which leads to a final thought, perhaps. If market forces and a desire for efficiency are driving banks to maintain these fairness-oriented appraisal practices despite deregulation attempts, what other areas of our lives, what other industries might be quietly adopting similar practices for similar reasons, even when the political winds change? Where else might efficiency and equity be aligning in unexpected ways?